All right, so now we're going to move along to not anymore primary, but what we call the enhancing characteristics of useful information. And so there is a hierarchy among these. Essentially, we would rather have a primary characteristic be appeased than an enhancing characteristic. However, enhancing characteristics are still considered important by the FASB's conceptual framework in determining how we want standards to be constructed to meet the overriding objective of an efficient allocation of resources in the capital markets. So with comparability, I call these the two C's, right? We have comparability and consistency. Now they're related but distinct, and folks can switch these a lot. Comparability is more concerned with at a moment in time. So if we think about two companies, we'll say during the years 2021, 2022, then what we're worried about with comparability is how can I compare those two companies at a point in time in 2021, or how can I compare those two companies at a point in time in 2022? Right? So we're wondering, all right, is net income of company A comparable to company B? That is, if company A reports $1 billion and company B reports $1.5 billion, can we attribute that $500 million difference to a real difference in performance, or is that just a difference in accounting methods used? Obviously, we want to be able to compare those two companies on a dollar per dollar basis. We would rather our reporting information be able to tell us, well, that 500 million difference is because of an inherent superior performance to the company that has that extra money, rather than, oh, they just chose to work their depreciation slightly differently, or they just chose a different accounting treatment when it came to, let's say, our research and development costs, right? So two companies at the same point in time. Now, when we go into consistency is comparing, except rather than at the same point in time, two different companies. Now we want to know that the same company over 2 points in time is able to be examined and conclusions drawn from their growth or their deterioration. So, and also give raw accounting treatments over that we'll discuss the course. The other two are verified, which interestingly, about 5, maybe even upwards to 7 or 8 years ago, it's hard to tell sometimes now, old enough, there was a switch. Verifiability used to be a primary characteristic. It was called reliability. But now it's been bumped down to an enhancing characteristic, and faithful representation has been promoted to a primary. So these things do evolve a little bit over time as new things are given importance and as our economies evolve. But verifiability refers that an estimate or a value, we could go out and poll, say 5 experts in the field, and they'll all get perhaps not exactly the same number, but they'll get something that is around the same number, right? That we won't have a wide dispersion, that we won't have something that looks like this, like a wide dispersion of estimates where people are all the way from 1 to 10, and maybe there's a little bit of agreement here. What we want is something more like this, where we have a very steep agreement around a very particular number. Now, this is extremely easy to reach when we do things like historical costs that we'll talk about in a moment, where we can just say, hey, this is the amount I paid for this asset back 5 years ago when I bought it. It is harder to get a consensus on certain things like mortgage-backed securities, non-rated mortgage-backed securities, collateralized debt obligations. Those are really fancy financial instruments. But there are times when verifiability, it makes sense, simplistic. Sometimes it's a little harder to achieve. Timeliness indicates that our information was either obtained before or at the moment it became useful. I mean, how many times have you heard it in your own life, yourself speaking at someone else, or even in a movie or a series, like, oh, wow, I wish I had known that, right? Well, when you have that moment of, I wish I had known that, the consequences already fallen out. Things are already, the cat is out of the bag, so to speak. And, you wish you had had that information prior to these consequences being felt. All right. Here's a good timeliness that students will know. It's timely for professors to return exams to you quickly, right? Because if they're like 2 weeks out, and I've been guilty of this once or twice, but I'm taking measures to ensure it doesn't happen as much. Then that feedback isn't timely in order to prepare for what you're doing next in the course. Next, we're going to move into an area where we're going to talk about certain assumptions, certain principles, and then constraints. So there are 5 assumptions. There are I'll back up off that for a second. You'll have assumptions, principles, and constraints. The first assumption is an economic entity assumption, and the economic entity assumption maintains that an entity is separate and distinct from its owners and other business units. Now, this sounds like, well, all right, of course, we're accounting for Starbucks differently than we're going to account for another coffee shop. Their records shouldn't be intermingled. It gets a little bit blurrier for students typically when we're talking about a sole proprietorship. Like, for example, if I went and started a company, then I would have to be very clear about the amount of money I was personally investing into the company. I wouldn't invest all of my money. And so certain things in my life would be separate from the company. For example, my mortgage wouldn't go on the company's balance sheet as a liability because that's my personal mortgage, and we have the economic entity assumption. It gets a little more ludicrous when you think of it in a corporate setting, because then the owners of the company are shareholders, and there's potentially hundreds of thousands of shareholders in any given company, and we don't report all of their individual assets, their cars or their car loans, those would be liabilities, of course, or their mortgages or any of the things that they own personally. Disney doesn't care about that from their shareholders. They're talking about the assets, the liabilities of the corporation, not its owner. The next assumption that we're going to talk about, which is a little less clear but should sharpen up and come into focus as we cover other items throughout the course, is the going concern assumption. The going concern assumption is just the assumption that the business will maintain itself for a long enough period in time. It won't go out of business any point in the near future. So this means that we can justify the use of accruals and deferrals. Accruals and deferrals we'll talk more about in a bit, but those occur when money is paid before an expense is recognized, or money is paid after an expense is recognized, or money is received before an revenue is recognized, or money is received after a revenue has already been recorded. So those are items that we need to consider. If we didn't have any going concern assumption, then there wouldn't be any point of recording. For example, a customer has paid me $100,000 for a service that I will render over the future time. Well, in that case, I received money up front. I would record what we call a deferred revenue. That's a liability, and I would only record revenue as I've earned that contract, as I've discharged my obligations as the company. If we could not assume that the company was going to stay in business, then it makes no sense to record the contract in that way, because then my future obligation may or may not have to be discharged. I might go out of business next year. I have their money. There's nothing they can do about it. So, that would turn into a legal concern and come down to the contract that was signed. Also, another more immediate and easily grasped consequence of this is that we typically don't report liquidation values for assets. Liquidation values just meaning current sale prices. The amount that we could offload any of our assets in a sort of, the company's going out of business, therefore all our assets are at market price. Balance sheet does not do that. So by and large, there are some assets that we do. We'll discuss that more in the balance sheet. Monetary unit assumption. The currency values are stable enough that we can ignore inflation. That is something that's important, as you know, right now we are going through an inflationary period, and we don't want that to start to mess up how we want to report real dollars on companies' corporate disclosures. We don't want to make adjustments for that. But it also further requires that accounts be recorded in a common unit of currency. So that means that there's certain items that we can't express in dollar value. We know they're important. They are assets to the company, but these are more like soft skills of good management, brand reputation. These items are undeniably important for the performance of a company and help maintain businesses' financial health. However, they are not able to be listed in a currency value. The verifiability, remember that enhancing characteristic, could not be obtained. So therefore, we're going to leave those off our financial disclosures. The periodicity assumption, this one is just saying, hey, if we want to, we can split up the financial time period of a company that we're reporting for, and it'll be just as good as a longer time period. Now, of course, the more data you have, the better picture you're going to have of the company. But what this really implies is that if I make an annual report, it is just as good at describing those 12 months as a quarterly report is at describing 3 months of a business, as a monthly report is at determining 30 days or 31 days of a business's operations. The ones that I think are really big in this, really the ones that are going to come up again in the class, mostly are going to be the going concern and the monetary unit. The other two are sort of, they're implicitly assumed by most people. They just needed it to be explicitly placed out there for certain things. Like I said, the economic entity assumption and an individual proprietorship. The next item that we're going to look at are principles. So principles, the first principle is principles. So this one's a big one as well. And it states that we got a mixed attribute system. What does that mean? Well, basically we have overriding techniques to measure our asset values. Historical value, not just asset, our liability values. So let's talk about those distinct items. We used to have total historical cost discipline. It means have a verifiable and reliable valuation of assets, and that is, well, how much did we pay for it? Who cares how much it's worth today? Because we're not intending on selling the asset today. So we're going to say we bought and constructed our office building for whatever, $20 million, and that means that is its historical cost. We put down the value of that new corporate headquarters at $20 million. Now, of course, we do apply some cost allocation over time. Cost allocation simply means that we are applying depreciation. If we're going to use that building for 20 years, then we would apply $1 million a year expense, depreciation expense, to that item. Other cost allocation buzzwords that should be somewhat familiar: amortization is depreciation, except it's applied to intangible assets, and depletion is depreciation, but it is applied to natural resource accounting. Just so that those aren't totally vague terms, those are items that you should be somewhat familiar with, and we will revisit later. This one, amortization, a little sooner than we will depletion, but we'll revisit them both over time. Depreciation is mostly strictly applied to fixed assets, or PP&E. Well, I'd say PP&E, but natural resources can be sometimes considered PP&E, but fixed assets, buildings, equipment, things of that nature. Now, that historical cost is very different than fair value. Fair value is that liquidation price that I said is not real common, but sometimes happens. And it is happening more and more over time. Around the time of the financial crisis in 2008, 2009, there was also a move to institute new measures of fair value around financial instruments, which caused a sort of chaos of controversy around this standard. Banks were already starting to feel the pinch of the real estate bubble bursting during that time, and a lot of their instruments were tied in some way or another to the real estate market. Well, these instruments were therefore being or suffering from an erosion of value that this new fair value standard said, hey, you have to record now the value of those assets dropping over time. You can't just hold them at historical cost anymore. And this was kind of a perfect storm of incidences that created what occurred, and some say made it worse. Although others say, well, hey, you can't really blame the thermometer for the illness. It's just revealing how ill you are. And so that's an interesting way to kind of view, or it's an interesting argument that is still ongoing in accounting. There's folks who say that we've gone too far into fair value. There's people who believe that we haven't gotten there fast enough. But these are the two main modalities of valuation that we use that contribute to our mixed attribute system, whereby we report different assets using different valuation schema. All right, I'm going to stop right there for a second, and we will pick up and look at some other deviations from in the measurement principle.